This episode is brought to you by Plaid. Plaid helps lenders approve more creditworthy borrowers without taking on more risk, combining real-time cash flow data with behavioral insights. It's a fast, familiar experience people trust and that actually converts. Learn more at plaid.com/FTT. Hello, and welcome back to another episode of Facing Credit, our podcast series where we dive deep into everything that's happening in credit and lending. For this episode, I was thrilled to be joined by Michelle Young, Credit Product Lead at Plaid, and Kiran Aware, Chief Consumer Credit Officer at LendingClub. Most of the time when we talk about credit and lending, we talk in pretty specific mechanical terms about what's happening with this score or what we could do with this new data source. In this conversation, I wanted to take a step back and think about credit decisioning and credit underwriting more at a system level, and to ask questions about how we can change the outcomes that lenders are getting if we think less in terms of the individual parts and pieces and more about the system as a whole. Obviously, the system as a whole is changing thanks to AI, thanks to consumer permission data, things that Michelle and Kiran are spending a lot of time on these days. And it was a great conversation to get into the weeds of how they think about that system and how it evolves over time. Really fun conversation, one that I can't wait for you to listen to. So without further ado, here is another episode of Facing Credit. This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. Okay, I'm excited about this. Kiran, Michelle, thank you both so much for joining me.
Excited to be here. Thanks for having us, Alex.
Thank you, Alex, for inviting us here.
Of course. No, any chance to convene a group of credit and lending nerds, I always jump on it. So very excited for this conversation. We're going to talk a lot about sort of building credit risk systems and credit decisioning systems and sort of thinking in systems. But before we get there, since I have you both here, I thought we could start by talking a little bit about the macro environment in which lenders are operating. And Kiran, I'm going to go to you first on this. I know there's a great deal of uncertainty in the market right now, even though I would say on a narrow sense, at least from what I've heard, consumer credit performance overall continues to hold up fairly well. And I was curious, especially with that sort of macro uncertainty kind of sitting over everyone, how you would characterize, based on what you see in your role, how consumers are doing with credit right now.
I think that's a great question. But before I get into that, I think let me provide a color on the target audience that LendingClub serves.
That'd be great.
So what we call our target audience is motivated middle. This represents roughly around 1/3 of the US population, nearly half of the non-mortgage credit wallet. So these borrowers have very strong profile, on an average, a solid FICO of 720. Income tends to be much higher compared to an average US population, about 50,000 higher. So these are high FICO, high credit, high income borrowers. They are digitally very savvy. They are financially engaged. They are very thoughtful in how they manage their money. So one way we always help them is lowering their cost of debt and pay off the debt faster. What we did see during the inflation environment is borrowers were under stress, especially from their capacity to pay perspective. We were probably the first one to recognize the stress through multiple leading indicators, like the reasons of changes in delinquencies and their cash balances going down. So we really acted and pulled back. Since then, actually, we have seen the borrower remain quite stable in terms of credit performance. These borrowers have adjusted more or less to the higher cost of environment. They have prioritized their credit usage based on where the economy is. But at LendingClub, we internally recalibrated our credit strategies to make sure it is tuned to the evolving cash flow behavior of these borrowers. And we continue to look at that. As a result, our credit performance has been very stable in last couple of years. And we have publicly stated that our performance tends to be about 40 to 50% better in terms of delinquency rate when we compare to our peers.
Got it. That makes sense. And maybe just a quick follow-up, Kiran, for you. I guess you illustrated kind of your specific segment of the market that you guys serve very well. And that makes sense to me that, like, in particular, that segment would be adjusting to higher costs well, who would be managing their credit in a thoughtful way. That makes a lot of sense to me. Do you have any sense of how kind of, and I spend a lot of time on Twitter, too much time, honestly, so maybe I'm over indexing on that experience, but the sort of like anxiety maybe that's starting to kind of burble up, I think particularly in like technology or other sort of white collar fields created by AI. And I'm sure it's probably not showing up in your guys's performance yet and may not for a very long time. But I mean, you guys talk to borrowers, you work with them in collections and servicing. Do you have any sense of like how they're reacting to kind of this sort of uncertain market, and in particular, like the threat of like economic dislocation or like the impact of AI on their jobs? Is any of that kind of coming through in your conversations with customers, or is it still too early?
I think that's like something that is on top of our minds. I think
Yeah.
we even just last a couple of weeks, I spent talking a lot internally with our management team as well. We haven't seen anything in our data come through. That's really what the situation is. However, having said that, we have multiple indicators that we are watching very closely. We have job industry classifications that we look at closely. We look at the types of borrowers and where they work actually very closely. So we have quite a bit of a system in place where we are able to detect if anything is behaving out of normal. So far, nothing has, we have seen it, but we are narrowing down further focus on potential jobs that might dislocate and have a close monitoring around it. Not only in our delinquencies, but as you said, like, are we hearing anything in our collections ecosystem, right? That will be key indicators for us to say something going on. But for now, I think we are very vigilant about it. We have a monitoring place which we'll detect right out of the gate, but it's a top of the mind issue at this point.
Okay, so Michelle, I'd like to come to you on this question too. How is macro uncertainty impacting how lenders are thinking, and in particular, given what you guys do at Plaid, how it relates to their investments in data, analytics, technology? What are you seeing?
Yeah. I mean, we've got a great perspective across the full spectrum of lenders. We work with mortgage lenders, unsecured lenders, the buy now, pay later space, auto. So we're really seeing quite a broad spectrum across the market. And I'll say there's like two key commonalities that I see that I think are really important as you think about the macroeconomic environment. The first is, if, Kiran and I are longtime credit people, it's not like there hasn't been some uncertainty in the credit market before.
Sure.
The very unique part of the world is credit products don't look the same. So if you think about where we are today from a consumer perspective, there is so much more optionality in the market as compared to where traditional credit products were in a 2008, 2009 world. And so an area where we hear a lot from customers is, well, how do I know what other credit products consumers have? And how can those be viewed as leading indicators? Are prime consumers getting earned wage access loans? Is, credit card usage really low, but buy now, pay later usage is extremely high? And that is something that is very top of mind. Kiran mentioned earlier cash flow. There's no surprise here at Plaid, we're going to bring up the concept of cash flow. It's something that we're extremely bullish on in terms of the impact that it can create for lenders to get that signal in order to really prepare for economic times as we think about that uncertainty. And so the big push we're seeing a ton from lenders across the board from every type of loan type is, how do I really know? How do I get that complete picture? And how do I see what I'm not currently seeing in traditional credit data to really understand what those leading indicators can be? And then the second piece, which ties into what we just talked about, uncertainty in the job market, is how do I know what income is? And then how do I know what income is after I give the loan? So the concept of knowing income in an origination process, not new. But the ability to see that income 6 months down the road, 12 months down the road, that's where we're seeing an investment of look at cash flow, understand what's happening at the origination process, but then be able to monitor that through the full lender life cycle to empower lenders to have the data to know then how to handle this on an ongoing basis and be able to better monitor their portfolio.
Yeah, that makes a lot of sense. And just to build on that point for a second, I think I'm glad you mentioned the sort of distinction between credit cycles, which obviously we've seen many different credit cycles play out over many different periods of time. They all are a little different in their details, but structurally similar in a lot of ways. And a lot of that data, by the way, is like represented in credit bureau data. And we have like lots of historical data that we can model against. A lot of the sort of industry standard scores are kind of built on that understanding. But I think the challenge, and I think it's more acute today than it really ever has been, just given the pace of change that we see in the market, is that the dynamics in the market are different, right? It's much more competitive. There's a much, as you illustrated, like a broader degree of products out there that consumers are using. And I think the other thing, and I don't know, Kiran, if you have a comment on this, but I'd be curious for your perspective. I also think like a more competitive environment also kind of changes the behavior of consumers, because like everyone is sort of a product of the environment that they're in, right? And today, consumers have more choices for how to manage liquidity, for how to get financing. Like they just have more options than they used to. And so that idea that Michelle was talking about of like, yeah, your credit utilization on your card is relatively low, or the multiple cards that you have, but you're using buy now, pay later. Are you using that strategically while keeping your credit utilization low? Are you using BNPL just as sort of a time value of money thing for specific purchases, and it's not strategic in that sense? Like the fact that consumers have more optionality and maybe are becoming savvier in how they sort of navigate all these different choices, that does make the model and the historical data and our understanding of how to navigate changes in the credit cycle different. So Kiran, how do you think about that kind of changing dynamic?
I think one of the best example I could give is generally traditional lenders or traditional credit environment look at borrowers snapshot in time. What I mean by that is two consumers may have very similar FICO, average income, average debt. Now the question is, if you only purely look at where they stand today, you would normally approve both probably and give them more or less similar pricing. However, what we look at LendingClub is not where they are today, but how they have evolved over the time to come to where they are today. Like for example, one of the borrower at the same debt level, although it seems like very similar FICO and income, could be deleveraging, right? He's paying down the debt and he has come to this point, which is a good behavior, by the way.
Yeah.
But another borrower who could have been very low in the credit usage, and then he's coming to the same point. That means he's racking up his debt. He's actually accelerating his debt usage. And now the risk profile of that borrower is very different than the one that is deleveraging. So like you need to actually tune your credit system to understand the trajectory of where the consumer is going, not where the consumer stands, because then you're likely to make better decisions if you stand where they're coming from rather than where they are staying.
Makes complete sense. And Michelle, I know he's speaking your language too, because you guys spend a lot of time thinking about real-time data and like a more fresher snapshot and an understanding of like the full context of what a consumer is doing and where they're going. I want to talk a little bit about, as I said at the beginning of this episode, thinking in systems. And just for context on this, I grew up in lending on the vendor side. And so our job was to sell solutions to lenders. And it was fascinating because that environment, I think for a long time, has been very stable, right? You have a loan origination system. Within that loan origination system, you have maybe a credit decisioning engine. That engine has a set of rules and a workflow that evaluates data pulled from different sources that's then compiled into features or attributes that then go into models that are then fed back into rules. And you sort of have this like waterfall workflow process for how you make a credit decision. Over time, that process has become smarter. It's had more data added to it. The models have gotten sharper. We've done a better job of sort of scrubbing out manual underwriting as much as possible and making it a quicker experience for the consumer and a more automated experience for lenders. That's been the last, 20, 30 years. And in that environment, there's a lot of change, but I would say the change is more incremental in the sense that, like, I used to be a part of these conversations a lot where it's like, hey, we have a new data source or a new model, and we would like you to look at this. And the lender would always go, okay, yes, happy to look at this. We'll put this in here. What you want to get is this spot in the waterfall. We already have this data source here. Let's do a bake off and see if you can earn your way to this part of the waterfall. It's kind of this like almost Darwinian like survival of the fittest of like where different providers fit in the waterfall. But from a lender's perspective, my sense was always that we have like a system we use and a relatively set waterfall and process we follow. And the question is just incrementally, can we find opportunities to add and lift by swapping one thing out for a different thing? To me, there's a very different conversation that's starting to happen now, which is thinking more holistically about credit decisioning and loan underwriting as an end-to-end system, the purpose of which is to produce an outcome, right? A portfolio of customers that you want that will perform a certain way. And I'm noticing lenders starting to think more in terms of that system as a whole rather than this kind of incrementalist approach that we've had, I think, over the last couple of decades. So, Kiran, I want to come to you first on this. Can you kind of give us your perspective on what it looks like to think at that sort of system level rather than just optimizing for individual pieces of it?
Yeah, and I think that's where probably we at LendingClub has developed significant edge over the others. So let me take a step back. I think consumer credit generally is described as a model.
Mm-hmm.
And by the way, it's far more than a model. It's an entire operating system.
Yeah.
So at LendingClub, we view consumer credit not like a singular algorithm or a singular model, but it's an ecosystem that connects the depth of your data, the scale of your data, to not a single model, multiple models that are actually optimizing across the life cycle. That informs your policies, pricing, verification. That also connects to what kind of fraud controls you want, how real time this should be, what kind of signals you should be look at real time. And ultimately, obviously, servicing and collections matters a lot of how you reach to the consumer, when you reach to the consumer, in what ways you reach to the consumers. But I think the most important piece of all of this is also a real-time feedback loop in all of these decision points that actually has to happen to improve the system. So you don't wait for that incremental value add. You're constantly looking at what's the next set of a bigger change looks like that can help me drive better outcome. At LendingClub, we have underwritten over nearly like 2 decades across multiple economic cycles. We have decisioned over 100 million applications.
Wow.
And that provides us a longitudinal view of how the consumer behavior evolves over time. So with that data foundation, we have built what we call it as a hyper customized machine learning ecosystem. At any given point in time, we have 60 production models in run across underwriting, pricing, verification, fraud, collections, all across the board. We have over 240 custom decision strategies that are finely tuned to what products they are looking for, what the channels they're coming from, what kind of use case of the loan is. So there are multiple aspects to that custom strategies. And underneath, I think we constantly look for custom attributes, which goes far beyond what I just mentioned is a single snapshot in time. So evolving cash flow behaviors. Their digital engagement across our ecosystem actually tells a lot more than probably a static credit bureau profile. So that actually empowers the entire system. But the models aren't enough, as I said. What you need is the ability to read the signals in real time and adapt quickly. Just to give you an example, we run about 200 odd experiments at any given point in time. That provides us real-time feedback across multiple aspects of the credit life cycle. And that helps us recalibrate our models and strategies. We have a very flexible decision infrastructure that enables making hundreds of changes each year. So when we think about thinking in systems, we're talking about the outcome from this entire ecosystem, not just a single model. It's an integrated process across data, testing, controls, life cycle monitoring, everything all together combined is the final outcome that you should be looking for.
That makes sense. That makes sense. And I think, it's funny, the word testing comes up a lot when you talk to lenders who think more in systems because they think about experiments and places we can change things and they think more holistically about outcomes. And I guess on that note, Kiran, one thing I wanted to follow up on real quickly is I think metrics really matter, right, with this type of thing, because if you measure the wrong thing, then you might optimize for the wrong thing and you might not be thinking holistically about like the outcome we're trying to create. So how do you guys at LendingClub think about like, okay, here's the system or the ecosystem that we're trying to sort of assemble all the pieces of. We're going to run lots of different experiments, but you're running these experiments with the goal of moving towards a good thing and away from a bad thing, right? Like you're trying to move in a particular direction in terms of performance. How do you measure that performance and what metrics kind of give you the best way to assess if the changes you're making to this system are moving you in the right direction?
Yeah, I think that's a good question. So for us, actually, the highest level, I would say, the strongest validation is the confidence of our investor community. Right? We have consistently delivered the unit economics, and that consistent performance, credit performance, has become a benchmark for a lot of our peers in the environment. So that's like an external view of how your credit system is working. There have been a number of validations for LendingClub's performance and credit itself. One noteworthy one is the Federal Reserve Bank of Philadelphia. They independently concluded that LendingClub's loan rating system is superior than the traditional credit risk measure in predicting the likelihood of default. Now, that's a rare external validation, which reinforces the strength in your credit framework. But when it comes to operational metric itself, we outperform the competition in delinquency rates, which is ultimate measure, by 40 to 50% across the spectrum. Our fraud loss rates tend to be less than 3 basis points, which is one of the lowest amongst the industry. About 40% of our delinquency interaction we resolve through self-serve capabilities. Now that not only improves the customer experience, but it's lower cost to collect. And even we continuously optimize the post-charge off recovery strategies. So that gives an edge about 25% better. So when I think about the, let's say, call metrics to measure the effectiveness of the system, I would actually try to notice you definitely need to have the KPIs that you want to look at across the life cycle. There's not a single KPI that would say like, yeah, you are doing great. You need to have health indicators across different vectors of your life cycle. You need to have expectations, but also you need to look at the competition, because both of those provides a view whether either in totality or in parts, whether you actually are pushing the right innovations in your entire ecosystem or not.
I'd love to add something there as you talk about the KPIs. Like the thing that I've been thinking about, what I've seen in my past, having been on the credit side as well, on the lender perspective, is everything comes down to the business impact. Like if you think about how you're looking at this from a credit only perspective, you might miss the big thing. And so what we talk about a lot with lenders is, what business impact are you trying to drive? Like, what is the actual change? Is it a delinquency thing? Is it an approval thing? Is it you're going into a new market, serving a new customer base, seeing a new loan type happen, changing your marketing channels? And I think what I love about the way that Kiran thinks about it is it's all about like the overall business impact and how you tie credit to that, and not think about credit as this standalone thing that's just preventing losses. And as you look at new data and test new data, like what are the other use cases it satisfies? Can you look at cash flow, but then you also get indicators around things like fraud and others. And so it's tying the types of actions you're looking at, the tests and the measurement, to like, what else does it impact? How do you make sure it's not just like one specific thing? And how do you actually drive that back to a business change is something that like we hear about a lot and we really advise customers on.
This episode is brought to you by Plaid. Approving more borrowers shouldn't mean blindly taking on more risk or adding more friction. The problem is that traditional credit data is limited, and cash flow data alone doesn't always tell the whole story. Plaid helps lenders see the full picture by combining real-time cash flow data with insights from the financial tools people already use every day. Those signals come back in seconds through a low-friction experience trusted by about half of US adults. That means you can approve borrowers who are stronger than their credit file suggests, spot risk earlier, and grow without loosening your standards. Learn more at plaid.com/FTT. Yeah, that makes a lot of sense. And maybe one thing that's kind of tucked into that idea that's worth calling out is like a lot of these things are not independent variables, they're dependent variables, right? And I think that's oftentimes underappreciated in lending where, Kiran, as you mentioned, like fraud is a credit risk problem, right? Customer experience and usability is a credit risk problem. The automation or lack thereof in servicing and collections is a credit risk problem. Like all of these things ultimately impact the performance of a portfolio. And Michelle, to your point, the business outcomes. And the business outcomes is a great point too, because a lot of times, and you see this with, I think, lenders that are very forward looking in the way they attack different markets, your strategy as a business might be, hey, we know this is going to make underwriting a little harder for the next 2 quarters, but it's worth it for these other problems we're trying to solve. And when the entire business is aligned around that, it makes it much easier. Whereas I've noticed with less sort of well-organized lenders who sort of struggle, the struggle is oftentimes against themselves a little bit, almost organizationally, where it's like the credit risk person is just heads down on credit risk. Like, this is the number I get, promoted or fired over. So this is the number I'm going to like apply all of my budget and all of my leverage to try to get it to go in the right direction. But working at cross purposes with other folks in the business or the larger business outcomes that the company is trying to drive. So I think, Michelle, that's a great point. And I want to come back to you, actually, Michelle, on, you sort of hinted at this already, but maybe to put it in more direct terms, we do seem to be at this moment where lenders are considering kind of larger systemic changes to how they approach some of this stuff. And it's not just to one part of the credit decisioning or credit underwriting process. Heck, it's not just even within the origination phase of the life cycle. It's acquisition, servicing, collections, kind of the end-to-end life cycle. Why do you think that's happening now? And kind of how would you characterize how lenders, maybe lenders who are a little behind the curve relative to someone like a LendingClub, are thinking about approaching this?
Yeah. It's funny. I always like to talk about, lenders on a spectrum. You've got those that are very sophisticated, that like they're moving on any new first data as quickly as possible. And then you've got those that are kind of following the trend of like what's happening in the market. How do I make sure I keep up with it? And then you've got those that, maybe are looking to see where things fully force them into change. And so I think depending on where you are in that spectrum, you're going to be looking at things differently. But I think the common thread across every lender, no matter where they are in their journey of sophistication, is the concept of alternative data is like somewhat dead. Like, we did a recent, survey in last year that talked a lot about, how willing are lenders to use alternative data. And it was like over 80%. And I think it's because the concept, again, what we talked about earlier is like traditional credit doesn't look the same. And so if you're not looking at multiple sources, if you're not actually going beyond just what's in a credit report, you're going to be left behind. And so it's not a matter of like, if you do it, it is how are you getting started? And so that's where, I think I've been on this wave of cash flow data and where it becomes important and how lenders are thinking about it. And it's starting to become a mainstream expectation that people are looking at this data. Lenders are going beyond the traditional credit box because you're going to miss something if you don't. And how do you actually get started? And so I think the conversation we've been hearing with lenders, no matter where you are in your sophistication journey, is where do I get started? Or how do I actually be leading edge in this space with using this data? Because it's table stakes at this point.
Yeah. Well, to that point, I think you're right about the alternative data thing. I mean, if you've been in this space long enough, you sort of remember the way data used to be talked about, which was like, here's the data we all use and know is valuable, and this is what we're actually using. And then alternative was like, I remember someone once compared it to like your teenage years, where it's like, for a little while I dye my hair purple and listen to punk rock music, and that's like alternative credit data, but it's like an experiment. It's a phase. You go through it and then you sort of come back to normal. I think the environment we're in today, to your point, for all the reasons we've been talking about, is very different. And the notion of even using the word alternative doesn't really make sense. It's much more a question of who are my customers? What segment of the market am I going after? What's my strategy for winning there? And what's the mix of tools and data I need to outcompete the market for that? And the answer for everyone, I think, looks a little different. Kiran, one thing we've been kind of dancing around a bit that I want to get your answer to is sort of within these systems, obviously what we've been talking about, a lot of it requires trade-offs, right? And it could be a trade-off between more or less friction. It could be a trade-off between different types of sort of risks that you're trying to control, whether it's like fraud versus conversion rate versus loss rate. Like there's lots of different trade-offs fundamentally within a system. And again, I think the benefit of not thinking in systems is that you can just narrowly lock in on one metric and not have to care about this. But for someone like LendingClub that does think more in systems and has this operating system view, you have to think about and navigate very thoughtfully the tensions between like which trade-offs do we want to accept and even just understanding what trade-offs you're making. So how do you guys think about those in terms of the system you built and even in terms of like organizationally, like, hey, I'm in charge of this. I'm in charge of this. Like, how do we sort of get together as a team and make sure we're all pulling on the same oar?
I think what you just called out is a classic environment that traditional lenders live in, where you have segregation of responsibilities and everyone is looking for their own vertical and optimizing their own in a way KPI. So one of the biggest, I would say, aspect of this is how do you balance that? And one of the most common common trade-off that you see is how do you trade off growth versus risk? For example, right, marketing teams will be looking for optimizing conversions and driving acquisition.
Yep.
And so that's their KPI. Whereas a credit person is looking for, is this the right credit profile and does the credit the performance make sense to us? Right? So, and if the decisions are taken in isolation, you may end up optimizing one component of system, but the overall outcome will look very weak. So at the end of the day, you actually have a weaker outcome. So at LendingClub, we do address this through what we call it as a core team culture. And what I mean by that is marketing, product, pricing, customer experience, credit are all integrated decisions. At the end of the day, any decision you talk about in any ways actually impacts what kind of consumer selection you're attracting.
Yep.
And that ultimately leads to your unit economics. Right. So for example, if you actually, when we talk about this a lot, which let's say we want to invest in a marketing strategy.
Mm-hmm.
The question that we not only ask is how much volume or conversion it is going to drive, but we ask the question, which is what kind of profile does it attract? And do we have the credit strategy, pricing, verification, fraud control, servicing aligned to that population that you're trying to bring in? Because at the end of the day, the success of a marketing campaign is not just driving a set of consumers, but having the right set of consumers that ultimately is going to give you better credit outcomes and unit economics. That's how effectiveness of marketing strategy will also be evaluated. So although we may tend to look at the decision point in the silos, but at the end of the day, the outcome is almost same universally, no matter in which function you're trying to do a trade-off, which is what is the consumer I'm attracting, what is the unit economics, and does that make sense to my institution or not?
Yeah, no, that's a great way of describing it. And it's funny you mentioned that, but I've sort of found once you start thinking in terms of positive and negative selection, which is a very sort of lender-oriented way of viewing the world, you kind of can't turn that part of your brain off. Like I just walk around in the real world just being like, positive selection, negative selection. Like you can't unsee it. Once you see it, you're like, like the whole world works this way. And I guess following up on that, Michelle, a question I wanted to ask you is, consumer permission data specifically, it does sort of adjust a lot of these trade-offs, right? Because we've spent decades working on kind of designing the optimal digital lending funnel, and optimal in a traditional sense, not necessarily where we're going, I don't think, but in a traditional sense, optimal meant like zero friction or as close to zero friction as possible. Obviously, when you ask a consumer to permission access to their data, you are introducing an additional step into the process. And I think that is maybe a really good example of okay, we're going to do this because we think it has value here, here, and here. But we know that we're making a trade-off in this way. And almost, I guess, my assumption would be that almost forces a level of system thinking as opposed to individual thinking. But I would defer to you, since you're the one who has all these conversations on a day-to-day basis. How are lenders thinking about that specific trade-off?
Yeah, I mean, friction's like a curse word in lending. It comes up and like everyone starts to get nervous and like, but look, the world has changed around consumer permission data. So I think that is a challenge that becomes a part of the discussion as we look at how this data can be implemented. Mm-hmm. But at the same time, it's all a value trade-off. And so going back to like, what's the business outcome you're trying to drive? How do you actually look at the right place to bring in this data for the right population, depending on, where you're trying to test and learn, or depending on what change you're trying to drive? It's all about finding the right balance. And I loved Kiran's point of like, you can't make the decision on your own as a credit professional. You have to bring in those on the product side. You have to bring in those on the marketing side. You have to bring in the other perspectives to say, okay, I believe that cash flow is going to have this impact here. How do we then position it in a way that we can bring it into our experience to really streamline? I also think we're in this interesting evolution of consumer permission data that if we were talking 5 years ago, I would be a lot more worried than what we're talking about now.
Yeah.
And I think from a Plaid perspective, like we've seen 1 in 2 Americans connect to the Plaid network. So likely by the time they're coming to you and sharing consumer permission data, it's not the first time that they've ever shared this data. The second piece that we see is our conversion of those that are actually completing the process from like the point in time in which I see the, hey, would you like to connect your data with Plaid, to sharing it with a lender is 80% of the time consumers are completing that process for a lending use case. And so the conversion has significantly increased. The consumer awareness around consumer permission data in general has improved. And from a Plaid perspective, our network has grown to drive the effects of, the ability for consumers to trust sharing that data, which I think puts us at a totally different position than we have been in the past. But the place that we see lenders most successful is going back to what business problem are we trying to solve? And then how do we create that balance? So if you get to zero credit risk, but your CAC is skyrocketing, that's probably not the right outcome that you want. But if you can get to a point to say, hey, I'm going to start with second look and I see this population and here's where I can increase approvals and that's my business outcome. Or I see certain things within credit that I know are risky. I want to see how risky is this because I actually think I can give them better pricing or whatnot. It becomes, where do you actually want to learn? And then how do you curate the experience around that, knowing that the process to share consumer permission data has significantly changed in compared to the past?
Yeah, well, I'm glad you mentioned that because like these things aren't static, I think is the other thing that's really important to think about. Like the technology improves, even things like, I know you guys at Plaid spend a lot of time thinking about, like, given the scale at which you operate, what's the level of insight you can like extract from that scale that maybe just wasn't feasible 10 years ago, right? And so I think there's a lot that can be done that's very different today in 2026 than it was even last year or 2 years ago. And so these things not being static is a really important thing to factor into any conversation about how you want to think about changing the system overall. And that brings us to the last question I wanted to ask you both. I'm constitutionally obligated to ask this question in 2026. But speaking of like, technology improving, we should talk for a second about AI and how AI potentially changes kind of these credit lending systems that we've been talking about. When I say AI, and I say this because, Kiran, you mentioned you guys do a ton of stuff around machine learning. A lot of very sophisticated lenders have done a lot around machine learning for years. When we talk about AI in a 2026 context, obviously we're talking specifically LLMs, agentic AI, kind of a very different type of model architecture. I'd be curious for both of your answers to the question of how do you think that technology will change how these credit systems look and function. And let's do sort of short-term, long-term. So let's start kind of short-term. Maybe what's a thing you're seeing that's happening right now or that you're experimenting with or that you think is kind of feasible to add value to these systems in the short term? And then we'll do kind of longer term predictions as well. So let's start short term. Kiran, I'll go to you first.
Yeah. So short answer, AI is here to stay and change how we think about lending. It's going to go beyond the play of taking out inefficiencies from the system or lending environment, but more towards how can you be more dynamic, how can you extract more signal, and how can you be more smarter in your credit decision framework. We are exploring AI use cases across the board: marketing, creative creations, compliance testing, audits, fraud workflows, operation workflows, right? So it's all over the place. I think when it comes to real core, which is the credit underwriting, because of explainability, it will take some time to get there, right? We need to have more deterministic outcomes rather than probabilistic outcome, which LLM tends to do, to inform, transparency in the decision-making process. Having said that, there are areas where in credit systems where it has evolved significantly. As an example, we process 90% of our loan without any human intervention. But for remaining 10% of the borrowers, we need some form of information. So by embedding AI as part of the integrated process in our fraud and verification processes, we are able to provide real-time feedback to the consumer whether the information he or she is uploading, is it in line with the requirements of what we would like to see. And that real-time feedback has changed the consumer process from days to minutes and seconds. Now, that not only benefits the conversion rate, but actually coming back to the consumer selection, the more good consumers can have better experience, they will stay along with your process. It really impacts your credit performance and unit economics. So when you think about embedding AI, you almost have to think about not just in that moment of the process, but the entire ecosystem as well. That's like a short an example of how we think about
it. Yeah, I love that. Michelle, how about you?
Yeah, I mean, I love this question because you're also talking to credit risk people who are notoriously the most risk adverse.
I know. I'm like, I can see the like sort of burbling anxiety where you're like, ooh, because it's like there's a lot of unknowns built into this too.
There's a lot of unknowns. And like, I also love that Kiran talked about, explainability and deterministic outcomes, because I feel like that comes up quite a bit with my team as we think through this as well. But like, look, I think my point of view is it's here to stay. If you're not actually looking at it, like you're going to be left behind. The way that we have approached it at Plaid is there is a ton of value in how it helps you improve your foundations. If we're from a categorization perspective of our transactions, the old days was like, I have human labelers and they go through and they label transactions. Well, AI companies came up, human labelers are in short demand. Yeah. So if you're using them before, you're not going to be using them now. And that's a place where we've said, hey, there is a ton of benefit to look at this, but you also have to be balanced. Like I'll give you an example. If we look at a direct deposit, do we need an LLM to tell us it's a direct deposit? Probably not. But if we look at patterns of transactions related to Venmo transactions and others, there are places where you're going to get a lot of value over scale in the ability to look at these things more broadly. And so we've approached it as, how do we drive value for certain areas where there is less certainty that we can really be able to make a better outcome or prediction related to things like categorization and others. And then from there, continuing to invest in new ways to learn where that impact it can be had and how we balance that. The thing that we believe is really important as we support lenders is everybody's going to be in a different place of their journey. So how do we also make our products configurable that those that are like, hey, I'm not ready for any of this. I don't want to use things that, I need the straight answer, yes or no. I need the explainability. I need to make sure this is deterministic. Can we support that in a way that they can configure what they're comfortable with? That's what's really important to us. Over time, I think we will see some of this change as we start to see the outcomes. As you start to test a traditional credit model that is built in the way we've always built them to one that is built in a more advanced AI way, we're going to start to see parallel paths of looking at both in a way that you can drive those changes. And I think as the culture around it evolves, we will continue to be more and more in a space where it becomes part of the regular way that we give credit.
Yeah, no, that
Especially
makes
actually on
sense.
a longer term. I think if I had to add,
Please.
I do believe the ability for LLMs and agentic AI is definitely the power to generate new signals and more continuously.
Mm,
Today, we have credit bureau attributes and signals that an analyst creates, but there is a real use case where you have some of this advanced technology looking at the changing behavior and
mm-hmm,
flagging them real time rather than
mm-hmm.
someone analyzing after the fact and trying to kind of implement in the system. So you will see with all this advancement, the credit system becoming more dynamic and
Mm-hmm.
probably more self-optimizing as we go forward.
Yeah. Yeah.
That makes sense.
I
That
love
makes
that.
sense.
And I think the other point of like, we think about it in the way of like, how does it change what we do? I
Mm,
think the other change that's so important is how does it change what a consumer does? Like, or how
yeah.
does it change how fraudsters are attacking,
Right.
the ability to get a loan, or like a
Mm-hmm.
consumer has, someone else, an agent actually making a credit decision on their behalf. Like now it's
Mm-hmm.
all of a sudden like, I didn't choose to default on my loan. My AI told me to do it.
Right.
And so
Right.
like, what does that look like? And so I think the other balance is not just, in the future, it's not looking at how do I just improve what I do? It's also how do I respond to the impact AI is actually having, where it's changing the patterns of the market that we are used to.
That makes a lot of sense. I'm glad you mentioned the consumer facing part because I think that's, we're not playing tennis against a wall, right? There's someone on the other side that we're playing against, and oftentimes multiple people that we're playing against simultaneously. And so you have to think about it again, thinking in systems, like thinking about the entire system and how it might change. That is a great place to leave it. I could do another 3 hours on this very easily, but your guys' time is valuable. Thank you so much for carving out some of it for me. Really enjoyed this conversation.
Same here.
Thank you, Alex. Thanks for having us.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.